Good morning, this is Annie Ken, Chicago Title. I'm the affiliate chair this year. It's an honor to be the moderator to conduct the lenders panel today. So today we have some awesome experienced loan agents. And first we have Phoebe from East West Bank, Chris from Gem Mortgage, and we have Mario from Kennedy Capital, and we have Richard from Guarantee Rate. So each one of the panelists, you have about 30 seconds to introduce yourself and tell us a little bit more about yourself. So we want to start with Richard.
Okay, didn't mean to kind of woke me up. Richard Zaletta, Guarantee Rate. I've been in the mortgage industry for approximately 30 plus years, so I've kind of been around a little bit. So if you have any questions, let me know.
Good morning, my name is Mario Manzanillo of Kennedy Capital. I've been in the business for over 20 years. I guess we're getting a little older now. But anyway, a lot of experience and quite a wide, diverse of situations. So that's me.
Good morning, everybody. Chris Hahn with Gem Mortgage. I've been in the business just going on my 28th year now, so quite a while as well. We've all had quite a bit of time doing this. I work for Gem Mortgage, who's a direct lender here in the city of Alhambra. I've been in that location for about 12 years or so. But do residential 1 to 4, anything involving residential lending. Thank you.
Okay, my name is Phoebe. I'm from East West Bank. I'm with East West Bank for over 21 years, actually maybe 22 years. And I really enjoy my work, and I specialize on home loans and also do commercial loans too. So I will talk about this program later, but I'm so glad that I can be here this morning to discuss the program that we have. Thank you so much.
Thank you. Okay, so the first question is to Chris. Are there still down payment assistance programs available out there? Are there still down payment assistance programs available out there?
Thank you for the question. Yes, there are still down payment assistance programs out there. Many people think there aren't, that they went away back when the market crashed and everything. But there are quite a few, and I was getting a little concerned because a lot of times you'll see income and sale price limits on some of these that make it unrealistic in some of the areas. But just a couple days ago, I saw one of the big down payment assistance programs out there increase their income limits to $128,000. So that now opens it up to a lot more buyers who might not have fit before. That'll get them up into the high 4s, low 5s probably. And they'll get down payment and closing cost assistance. There's many programs, and probably all of us offer them in one form or another. Maybe not all the programs, but they will give down payment, closing cost assistance, and help buyers to get in with money that they didn't have. As long as they've got stable jobs and good credit, the money part can be covered, at least most of it. Probably they'll need a few percent, maybe 2% or so, but the programs can cover most of the rest. So they're still out there, and check with any of us to see what's available. Thank you.
So here's a question to Richard. QM mortgage versus non-QM.
That's a very good question. I know this is something that has transpired since the mortgage meltdown when we all went through the housing crisis. As you all are aware, the Dodd-Frank bill was introduced in 2010. At that point, they came out with what's called QM, or qualified mortgage, which basically means now we are very restricted and we have to actually qualify the client to make sure they can afford the house. Where before the meltdown, everybody was getting houses with no income. Now you actually have to verify and qualify that person. So that I like, because it was the old school, the old way of doing things. Then they came out with non-QM, or non-qualified mortgage, which basically means you don't qualify with income. They have what's called alternative documentation, bank statements, stated income, interest only. Those are what used to be called the subprime. Now they're actually called non-QM. The nice thing about that also is with the non-QM, they're not as risky as people think, because you have to have a high FICO, you have to have money, you still kind of have to show the ability to repay some way. So there's not as much risk, when you're looking at a non-QM versus a QM, but it makes our job a little more difficult because we got to know which way are we going to go. So it's going to be one or the other. Thank you.
Here's a question to Phoebe. For asset-based loan program on the single-family home, what are the guidelines for foreign buyer?
Okay, East West Bank offer what do you call it, asset-based program. We need to have a 40% down, and then if you have a home, then there will be 18 months reserved, PITI. The 18 months you can use your stock account or your retirement account, or even life insurance cash value. So we can use that on the reserve. But let's say the foreign national here that only have one home, that's the first, you're going to buy a house in the U.S. And so that asset base is increased because there's no home in U.S. So what they do is they asking for 60 months PITI, which is a little 5 years. It sounds a lot, but then, because this will make it so flexible and easier, that we do accept that if you were having money in China, we accept the China bank statement too. So that's really a plus for many foreign national, because right now the money is very difficult to send it to here U.S. So all we need to have for foreign national is a valid passport, and also 40% down and 60-month PITI reserve funds. So that makes it really easier that I did a lot of foreign national. And the rate is very good, it's very competitive, but it's really geared to people from China, Taiwan, or from Asia, that people looking for homes right here in the US. Thank you.
Okay, this question is from Mario. What are the 2018 Fannie Mae and FHA new loan limits?
Well, good morning, everybody. The good news is this. Every year, Fannie Mae, FHA, which is FHFA, actually, the Federal Housing Finance Authority, Freddie Mac, all of them, they're the ones that set our guidelines. So get that in mind. They're the ones that set the debt-to-income ratios, all of this stuff that we go through. But every year, they also do an assessment about the loan limits. Last year, the conforming loan, when I mean conforming, is what you see advertised out there. It was 417. Fannie and Freddie now they go to 453, 100 this year. So it's a little bit higher than last year. So what happens if it's a $500,000 loan? It obviously goes beyond this loan limit, so it's considered a high balance, a little higher interest rate. FHA also did a grade assessment, which is now 679. This is for the LA County, because Riverside, San Bernardino, other counties have different guideline on loan limits, but FHA for the LA County is 679, which a little bit more than that, 679, 650. What that means is that it covers quite a bit of this area for most of the homes. That's with 3.5% down. So there is a great, those loan limits will help some buyers for the 2018. And every year they do an assessment and we get notified. We all know about this new loan limits. So please make sure that you have this awareness and help your clients for this coming home buying season. Thank you.
Thank you, Mario. And we're going to have a Q&A at the end. And also, we have a friendly reminder for all the panelists. Today, we are going to share our knowledge, and then we are not going to promote, their companies or their products, and mainly just sharing the knowledge. So the next question is to Chris. Has FHA changed its stance on allowing hero and PACE liens with FHA financing?
Thank you very much. As all of you are probably aware, a lot of these home improvement financing that these solar companies and window companies and door replacement companies are going out to homes and making it sound like the best things in sliced bread to tacking onto their property taxes with a hero or PACE lien and making it seem like, oh, your payment's only going to be this amount because we're going to make it so easy for you. Well, they make it certainly easy for the client to get their product, but they make it entirely difficult for us to sell real estate now and get financing for real estate with these liens against the properties. There was a period of time when FHA in 2016 instituted an allowance for PACE and hero liens. Well, come January 5th of this year, they said, well, we've rethought that and realized that it's not a good thing to do, that it jeopardizes the borrower's position, the lender's lien position, because the tax is a priority lien. That could take precedence over the lender's products. So they don't like that. So it has now been taken even away from FHA. So pretty much, if you've got a PACE or a HERO or one of these improvement liens against your property, you're going to have to notify your sellers that upon selling, they're going to have to pay that lien off if the buyer's going to get financing. So, not a good thing. I wish they would do something to change how these companies advertise and put that out there, because it's not helping the client in the long run. It might help them to get what they need done, but when they sell, when they try to finance, they're going to have trouble. So, let your clients know ahead of time, because they're going to get approached by all these people, and you don't want them to be in a position where you can't sell their home in the future without them having some kind of negative benefit. So, keep in mind, PACE, HERO, none of the lending programs allow it now, so be aware, let your clients know, and I think we can hopefully change that a little bit.
Thank you, Chris. So this question is for Mario. What is debt to income ratio?
Debt to income ratios is pretty basic stuff, but there is a lot of confusion, especially when you're not in the industry. This is something that we all work with. And what it comes down to is something like this. We get a phone call and we'll say, hey, I have a client, he makes $10,000 a month, 760 FICO score, and has at least 10% down. Great. Well, how much can we get? We're all happy, I'm all excited. I'm about to, wow, this is great, we got a transaction. All right, let's run the credit. Now, we found out that under his credit with car payments and everything else, has about $4,000 in debt. And then you add the mortgage and now it becomes like about $7,000. So now, here's the question for you. Does that client qualify with a $10,000 income, 700 FICO score, 740 FICO score, 10% down, and 70% debt to income ratio? How many of you think that he qualifies? Sure. Sounds good. Sounds good? Bob is a lender, so he will risk it. So you go to Bob, see? But actually the Fannie Mae Guidelines, they usually go on FHA, you're talking about, FHA goes to 55%. So when you look at that, is that you have to, it's basically, notice what I said, 55%. So it is a percentage of your gross income that goes into the debt payments. That's really the definition of the debt to income ratios. So it gets to a point where that is one of the 4 C's, is the capital, credit, and this is debt to, this is affordability, right? The capacity to afford the home. Like he said, on QM mortgages, that's what they're gonna look. Can this person afford a mortgage? So in that capacity, you need to be, this is part of our pre-qualifications and pre-approval process. So make sure to optimize your clients is to lower the debt before they buy. That's one of the, to optimize their ability and capacity to buy a home. So that's my answer to the debt.
Thank you, Mario. Thank you. This question is for Richard. Can you close a loan in a living trust?
This is a very interesting question, because I know for years that I've been in the industry, living trust was always a no-no. You could never, ever buy a property under living trust. The guideline has changed. You can now buy a property under the living trust without having to take it out of the living trust and then put it back into the living trust. The person that is responsible, or the person on the living trust, must be the borrower. So they have to be the person on the living trust. They must be duly qualified under the applicable law to serve as the trustee. They must be the grantor, and they must be fully authorized under the trust documents to pledge and otherwise encumber the trust assets. So those requirements have eased up the guidelines Because I do get that question asked every once in a while, can we close under a living trust? And I'm sure people that have been around for quite a while have always, no, you can't. You got to take it out of the trust, close the transaction, put it back into the trust. That creates some problems for people because they don't like doing that. It costs money, they got to get lawyers involved, there's things they have to do. Well, guess what, now we can do it. So if you have somebody that's in a living trust, and they want to buy another property, or they're looking to buy their first property, it can be done nowadays.
Thank you, Richard. Here's some questions for Phoebe. What are the guidelines for apartment loan?
Okay, the guideline for apartment loan that we do what we call stated income, and you do have to provide 2 months bank statement for the program, and then we have to do the loan amount can up to $2 million, and to qualify for the apartment loan, it really weighed a lot for the income that the apartment generated. Okay, so we do have what we call debt cover ratio guideline, which is like we have stress test. So remember now to make sure if you want to qualify the apartment loan, make sure you call me or whoever do that. Make sure to qualify before you offer do the offer for the purchase for the apartment. The apartment guideline is like we don't need tax return, what we call state income. And we do for national also. So I think it's make it if you're out there selling apartment that you know that we can able to help the customer to get the apartment purchase done. Or even if they have a customer want to refinance, we do that also. Again, if it's a rate in term, then we don't need tax return, but the cash out that we do need a tax return. Thank you.
Thank you, Phoebe. This question is for Chris. Have there been any significant changes with FNMA guidelines over the past 12 months that help buyers to qualify more easily?
Great, so it's Fannie Mae Guidelines, conventional guidelines. Have there been changes that will help our borrowers moving forward? And yes, there have. There weren't a lot of positive changes over the last 8 to 10 years to help borrowers to kind of loosen up guidelines a little bit. They went really, really restrictive and tight, of course, after the crash, which was probably necessary at that time. But there have been some great changes. One of them Mario alluded to a minute ago in regard to debt-to-income ratios. Prior to the crash, debt-to-income ratios could be 60%, 65%. Total debt-to-income, meaning future house payment plus all your other credit debt divided by gross income could go to that. They cut that back to 45 when the crisis happened. From 65 to 45, that's a huge cut. That's probably $150,000 difference in qualifying. So it made a huge difference. So now they've finally increased debt ratio from 45 to 50% on conventional loans. First increase since like 2009 probably. And how much does that help? Probably at least $50,000 more in buying power. So not a ton, but every little bit counts. So that's a huge one. Of course, the income limits increased, which is great. LA County, we haven't had too much problem with our income limits, but places like San Bernardino, last year you were at $369 or something like that. You're buying property for $400, $450 in some of the nicer areas out there. You couldn't finance with low down payment. You had to put a huge down payment. So now at least it's brought it up to the $450, $300, $100. That's going to be really reasonable for some of those marketplaces where the first-time buyers are having to go to be able to afford property. Fannie Mae has reintroduced a ARM product that is actually a very nice one and very favorable to the borrowers. I haven't seen too many people looking at adjustable rates, but rates are going up, folks, and you're going to see that they are probably going to go considerably higher over the coming year or so. I hope not, but that's pretty much in the works. 3 more rate hikes possibly this year. That's going to raise things, so we'll have to see. But they've introduced a 5-5 ARM, meaning fixed for 5 years, and when it goes to adjust, it'll be fixed for another 5 years. So it continues that way throughout the 30-year loan period. Better than just fixed for 5 years and then adjustable for the rest of the time. You're going to have a relatively safer adjustable to go into with caps of 2% when it adjusts. And that's a new, well, it's an old Fannie Mae program, but they reintroduced it, so that's awesome. Properties previously that were listed for sale, you can do a cash out refi without all these other layers of things, have to wait a certain period of time and all that. Now you can do a cash out refi on a property that was listed for sale as long as it's pulled off listing before we fund the loan. And that's Fannie Mae, so across the board, everyone has got it. Another big one for debts, you got a debt that you co-sign for, but the other party's paying it. We need 12 months proof that they're paying it, and then the lender won't count that against the borrower. Before, they had to be also a borrower on that loan, the non-mortgage debt, like the car loan, the person that you co-sign for, they had to be on the loan as well. Because if they weren't, we figured, shoot, if I don't pay, it's going to mess up the credit or whatever the case. So now they don't have to be a signer on that loan. The person you co-sign for, their name doesn't have to be on the loan, but you have to have the 12 months proof. If it's a mortgage, yes, they have to be on that loan. And then student loans are a lot of changes, but someone else is going to address that, so I will leave it at that. There were other minor things, but these are probably the biggest things I think will benefit buyers moving forward in the coming years. So, thank you.
Thank you, Chris. That's an awesome information. So this question is for Mario. Will there be changes to credit standards in 2018?
That one, I'm going to reemphasize a couple of things. Instead of the credit, I kind of want to revamp that question into upcoming changes that I think that would be very important. As you can see, our industry evolves. And again, the key is who evolves. He has mentioned it, Fannie, Freddie, FHA. These things keep evolving. Just, he mentioned something very important, and so all of us. The one thing that is happening, and Chris already touched up on that, I just got this from the Mortgage Banking Association. We get these reports. Here's the projections, and obviously these are projections. The interest rates will be going up somewhere between 4.25% to 5%. Now, why do you want to know this? Home buying season is coming up. I would say help your clients before this starts coming up. Okay, this is the projections, and they will continue to go up as we go along throughout the years. I don't know to how far, but this is for this 2018. One really important, and I think this one is going to catch everybody by surprise, but it is on the pipeline, and it is a fact. The LIBOR, which is the index that they've been used for over the years for most of the adjustable rate mortgages, is going away in 2021. So here's the thing. So what's going to happen to all of those people that have already adjustable rates when this expired in 3 years? We don't know yet. So the adjustables, although they do have, I'm pretty much sure that somewhere the FOMC, which is the Federal Committee there, they will address this issue coming up because they have to tie it in. We don't know yet what the results are going to be. So this is a caution that is coming because the LIBOR index, which is used a lot for all of our adjustable rates, that's going to be done on 2021, and there is not yet a decisive what index they're going to use. So that's another big change. Our industry keeps evolving, and all I have to tell you, and I close with this because just recently I attended a meeting, and I happened to meet a guy, I'm sure you heard his name, Vince Ferragamo, formerly quarterback for the Los Angeles Rams. And he said something very interesting, and I happened to talk to him very one-on-one, and on his presentation he said 2 lines. He said, you want to go fast, you go alone. You want to go far, you go together. That's teamwork. This is a team effort for all of us. There are the lenders, realtors. It's a team effort. We want to go far. We want to help your clients. So please, that's how I leave it with that.
Thank you, Mario. What are the guidelines for SBA loan?
Okay, I guess we change gear now. We're focusing on SBA stand for Small Business Administration, which is only actually for commercial purchase transactions. The guideline for SBA it's so simple. Okay, if you want to get P qualification for a client, let's say they're going to buy a warehouse or they're going to buy a restaurant, they're going to buy. We can also case by case, even a gas station, but really have to be check it out. All you have to do is ask the client to give 3 years of tax return, and then a financial statement form that complete by your client, that we can give you a P qualification to purchase a commercial property, for that. And the down payment is little as 10 to 15%. I think it's very, very useful. We do on the SBA guideline, we can also do tenant improvement. So additional apply to the buying a building. They also, if you qualify, to get a top of the loan for tenant improvement and also working capital if the borrowers qualify. Good thing is make sure the clients are having 3-year tax return, and in the business hopefully also 3 years, so they can qualify them that way. And I think not too many people know about SBA loan, but it's very, very useful for a client if they want to purchase a commercial property. Thank you.
Thank you, Vivi. Here's a question for Richard. Student loans affecting qualifying?
This is another interesting question, and thank you, Chris, for not going over it before.
I knew you were covering it.
With student loans, it's been a back and forth, up and down, where before, when you had a student loan, if you can show deferment for 12 months, it was not used to qualify. It didn't hit you as far as debt to income ratio, so we did not hit that payment to the client. That has now changed. FHA, Fannie Mae, and Freddie Mac have all changed it to where now you have to hit them for that student loan debt, even if it is deferred for 12 months. We either use the amount that is showing on the credit report, because when we run a credit report, it will show me what the minimum payment is. If there is 0 put there, I have to hit them with 1% of the total amount due, which could make or break a deal. Because if you have a client that has $15,000 in student loan, that's $150. That could break a deal. Or I have to get some type of payment arrangement from the client with the debtor that they have the student loan with, of what their minimum payment will be. Then I use that payment. Now the good side, VA, they do not count student loan against the client as long as it's deferred for 12 months. However, if you're in the transaction and the transaction will close and there's not 12 months left on the deferment, then I do have to hit them with the minimum payment, the same as I would Fannie, Freddie, or FHA. We have a lot of discussion right now, and I'm sure you hear with Congress, Senate, the President talking about the student loan and the debt, and how are we going to eliminate it? Are we going to forgive it, or we're not going to forgive it? We don't know what they're going to do. So as of right now, student loan debt is still a huge hindrance in trying to qualify a client. And unfortunately, these people, they pay for their education, they want to get a better job, it's going to hurt them in the long run. And I feel sorry for some of the guys, because I've seen student loans where doctors and lawyers, you're talking $200,000, $300,000 in student loans. They're never going to pay it. I don't care how much money you make, you're not going to pay it, because unless they pay it off in one shot. But at least we have ways around it if we need to.
Thank you so much. Now we're going to open for a Q&A. If you have any questions, please raise your hand, and we're going to go, okay, go ahead.
I want to know if you own the residential property, if the property is an LLC, you do the loan.
Yeah, you could do it but unfortunately you have to pay 1 point additional that the borrower can be LLC.
We're talking about East West, but how about?
Oh,
Freddie Mac?
There are lenders out there. We have a product there, but I'm not talking about product, because I'm sure that everybody can probably accommodate. They will do a LLC, but just keep in mind that once you start getting off the Freddie Mac and guidelines, it starts becoming a little bit more expensive. So they will do it, and it's just a matter of does it make sense. But yes, there's Richard, I'm not sure if,
Can I follow up? So if someone buys a property under their own name, eventually they put it into LLC. Will Freddie and Fannie call that loan?
Will they call a loan due?
Because they realize the change.
No.
But you know, the insurance statement every month,
No, because when you apply for the loan and that person obtained the loan as an individual, Freddie, Fannie, they will always look at it as that individual. They always can transfer title and the loan is not being called due. So you can change title, but the bank is not going to say, well, you changed title, so now I want the loan back.
even the insurance is changed, the insurance statement changed, they don't care.
They don't care.
Thank you.
Well,
I want, I think it was Mario that said this. What is FHA amount for FHA now?
oh, the loan limits for FHA, they're at 679, I'm sorry, 679, 950.
Is that for LA County? Or?
LA County, yes.
Okay, and what is it for San Bernardino County?
I don't have it in front of me. I actually did bring the, do you have that one?
So San Bernardino and Riverside are the same,
Okay,
and it's different whether you're talking about 1, 2, 3, or 4 units. So single family, everyone is 453, 100. 2 unit, 580, 150. 580,000, 150. 700, 1,250 for 3 units. And 4, 871,450.
okay.
And that's Riverside and San Bernardino. And both LA County and Orange County are high-cost areas. That's why they allow the 679. And then units, 870, 225 for 2 units.
Is that LA County?
County.
LA
Yes.
County,
Is it 872?
870, 225. 1,051,875, 875, so 105,1, 875 for 3 units. And 1,307,175 175 for 4 units. LA.
Just to add one more thing, if you consider high-cost areas, I have Alaska, Guam, and Hawaii, and U.S. Virgin Islands. FHA here, LA County, 679, 650. Alaska, Guam, and U.S. 1,019,475. So you can see the big difference. I'm just kind of as a perspective of how it is in some of these other states. So
I don't think my clients will be going to Guam.
Hawaii, but that's FHA. That's amazing.
oh, well, before that,
I'll wait too.
Okay, go ahead.
so we're gonna open,
Go ahead.
so we're gonna open 2 more questions and then see.
Okay, they have a graduate program before. Do they still have it now? That means those new graduates, they pay 3,000 today, maybe slowly, 2 years later, they pay 3,500 or 3,800. Those kind of graduate program, do they still have it anywhere?
The only program that I know of as of right now is a doctor or a medical program where they get in with a very low down payment and qualify with their proposed income.
Are you saying graduated payment mortgage?
Graduated.
Yeah, they've always had those. I think you can structure them with any Fannie Mae, Freddie Mac type transaction. But it's like you're paying in advance to buy it down for the first year, like a 3-2-1 buy down might be 3% below the note rate the first year. Second year it's 2% below the note rate, and then the third year on it becomes at the note rate.
Yeah.
They have those, but you're paying into it to make it work like that, so not necessarily super attractive.
Going back to closing under a trust, does that also apply to refis? And it does?
Yes.
It does. Thank you. And then what was the effective date of that change?
I don't have the exact date that it was changed, but it was, I think, last year that it was changed.
So
And there are some investors that still don't like it, so you gotta make sure it's an investor that allows you to do it. Even if Fannie and Freddie do it, some will have their overlay that say, no, we're not comfortable.
Thank you so much. Due to the time limit, we have to wrap it up. So first, please give a round of applause for all the panelists today. They're awesome and they lots of knowledge with us. Thank you so much. And now I'm going to turn the program back to Chad, the MLS chair.